sort of focusing on the management of risk. So the idea that I will be putting across is all investments have inherent risk. Should we be driven by trying to figure out where's the best return, or should we be driven by the fact that we want to manage risk appropriate to our investment objectives? And that is what I'm talking about. Next one, please. We've talked about the risk, both political and economic, that Pakistan faces, has continued to face, and that's something that's always there. Whether it's Pakistan, whether it's any other country, these are issues that people face in terms of risk that impacts investments. But it is the uncertainty that also then creates opportunities. There are times when we can identify opportunities, and indeed, as Dr. Amjad Wahid just pointed out, that there appears to be an opportunity in the equity market where it seems to be underpriced. But usually, most of us are not able to move quickly enough to capture on those opportunities, and we have to accept those limitations. We can't always be on the ball, be able to figure out everything that's right all the time. If that were possible, most people involved in investing of sorts, whether equity, debt or otherwise, would be doing wonderfully well, but most of us do get it wrong every now and then. So we have to depend more on the behavior of different asset classes and then align our investments to the investment objectives that we have. We have a fair amount of historical data based on which we can take these decisions, and I'll be talking about that. The next, please. The big risk is of misallocation amongst asset classes. We may have a situation where we are invested in prime real estate, in gold, in some blue chip stocks, in gilt-edged government bonds, deposits with strong banks, and perhaps even some money tucked away abroad. And we might think, okay, we can sleep easy, no problems. However, if the assets are not aligned to our objective needs, we can go terribly wrong. And that is what we need to do, is make sure that for each need we have the appropriate allocation. And all of us have different needs. When we put away money for the future, it's for various objectives. It is not just one large objective. And therefore, we can't just simply say, okay, here's a pool, I'll put X% in stocks, X% in bonds, X% in real estate, and et cetera, and I'll be fine. No, it's specific to your investment objectives that you need to have your asset allocation. In itself, you cannot quite call an asset class risky or risk-free. It depends on again, the objectives and the time horizon available to you. Typically, most people would say government bonds are risk-free. Fine, I can put away money in that. And typically, we've seen a lot of provident funds put away money into government bonds, say, fine, we are fine. But what happens is when you do up your financials and someone is leaving the company and has to cash out, and based on the latest financials that you've done up, if you mark to market the government bond portfolio, it may have taken a knock. Just about a year ago, there was a 20% knock in the 10-year government bond. So, and that is explained by the next slide. Basically, what happened was that interest rates shot up over a short time period. from around, on the 10-year bond, from around 10% yield level to 16%, which in turn resulted in, for those who were already holding those 12% bonds, a loss in valuation because the market now wanted 16, and that was roughly 20%. And we've seen two such periods in the recent sort of past of, say, the last 10 years or so, where government bonds have taken a major knock. Next, please. So the other argument might be, fine, let's not lock ourselves into the 10-year bond because that can take a price hit. Let's go into the short-term treasury bill. The 3-month treasury bill is considered absolutely risk-free, no risk of default, no price volatility because of interest rate movements, might be the perfect instrument. But obviously, if we end up putting away, let's say, our pension savings over a long time into these treasury bills, these are likely to underperform inflation. So what we will be doing is saving some money today. You know, say you buy one less loaf to consume today, and find that when you retire, you can only buy half a loaf with your money and the interest earned thereon. So really, you've got to keep that in mind. It's the objective of that particular investment where something is suitable or otherwise. Again, there are these things called TFCs, the term finance certificates, simply government bonds. Typically, most are issued with a 6-month interest rate refixation. So every 6 months it's refixed. So there again, you do away with the interest rate risk or the underperforming of inflation. And let's say if you were to invest in high quality, let's say AA or better TFCs, you might think you have the perfect answer. But then we've seen in market conditions where liquidity goes away, even a very high quality TFC at times you cannot sell at a fair price. So the risk is there of not only the inflation risk or the credit quality risk, but also the liquidity risk. So we've got to keep that in mind as well. So when we are investing, again, we can't simply take a simplistic view and say, fine, I've got a perfect instrument. Nothing is perfect. And at the same time, nothing is absolutely wrong for you. It depends on your needs of your overall assets as to how you need to allocate those. And I'll be talking more about that. Shares, as Amjad has very clearly sort of talked about, they're outperforming other asset classes. But there is the price volatility, which he talked about, and I'll be talking more about it. A similar thing of real estate. At times, the market becomes highly illiquid. Investing abroad, the last couple of years, people have had sleepless nights and perhaps lost a lot more than simply sleep, whether they invested in real estate in the Gulf region or perhaps had money in a bank abroad that collapsed. So clearly there are issues with that too. Gold seems to be doing wonderfully well these days, but let's not just forget that there was a period of 30 years at a stretch where if someone had bought gold at around $700 back in 1979, they had to wait for 30 years for the price to come back to that level. And the next slide sort of shows that arrow over there clearly indicates that there was this huge period of 30 years. So if you'd invested in gold then, you were in deep trouble for 30 years. So everyone's investment horizon is not 30 years. So it depends again on what your needs are, and you have to invest accordingly. So the key is the right asset allocation for each investment objective of ours, for each need. For my retirement, I need to have a different investment policy. For my